The moment you swipe that little plastic rectangle, an invisible financial symphony begins playing across the globe, and what happens in those 3 seconds will absolutely blow your mind. Most people think they understand credit cards, but the reality is so much more complex and fascinating that it reads like science fiction. Picture this scenario. You're standing at your favorite coffee shop, card in hand, about to pay for your morning latte. The barista swipes your card, and in that instant, your purchase information rockets through fiber optic cables at the speed of light, bouncing between banks, processing networks, and security systems spanning multiple continents. Before you can even say thank you, at least 7 different companies have touched your transaction, each taking their microscopic cut of your $4 coffee. But here's where it gets really wild. That credit card company just gave you free money. Actually free money. And they're betting everything that you won't be able to handle it responsibly. It's the most profitable legal gamble in human history, and you're both the customer and the product. Let's rewind to where this whole story begins, because understanding how credit cards actually work requires us to travel back to a dinner party in 1949. Frank McNamara, a businessman in New York, found himself in an embarrassing situation that would eventually revolutionize global commerce. He was dining at a fancy restaurant when he realized he'd forgotten his wallet. After his wife had to come rescue him with cash, McNamara had an idea that seemed almost ridiculous at the time. What if people could pay for things without carrying cash? This moment of social awkwardness sparked the creation of the Diners Club card, which was really just a cardboard charge card that worked at 27 restaurants in New York City. But McNamara had accidentally discovered something profound about human psychology and economics. People would spend more money when it didn't feel like real money. Fast forward to today, and that simple idea has evolved into a global financial ecosystem worth trillions of dollars. When you receive a credit card in the mail, you're not just getting a piece of plastic with some numbers on it. You're being handed a sophisticated financial instrument that connects you to the most complex payment network ever created by human civilization. Here's how the magic actually happens, step by step, because this process is far more intricate than most people realize. When you hand your card to a merchant or insert it into a card reader, you're initiating what the industry calls a 4-party transaction. These 4 parties are you, the merchant, your credit card company, and the merchant's bank. But in reality, there are actually dozens of companies involved in processing a single purchase. The first thing that happens is authentication. That magnetic stripe or chip on your card contains encrypted information about your account. When the card reader scans this information, it's looking for specific data points that prove you are who you say you are. Your card number, expiration date, and security code are just the beginning. Modern cards also contain tokenized information that changes with every transaction, making fraud nearly impossible. Once your card is verified, the real action begins. The merchant's point-of-sale system sends your transaction data through what's called the acquiring network. This information travels through secure internet connections to your credit card company's processing center, which might be located thousands of miles away from where you're standing. Now here's where things get really interesting from a business perspective. Your credit card company doesn't actually want to approve your transaction. They want to decline it. Every single purchase represents risk for them, because you might not pay them back. So in those milliseconds while you're waiting for approval, sophisticated algorithms are analyzing hundreds of data points about you, your spending patterns, the merchant, the location, the time of day, and thousands of other variables to determine whether this transaction looks legitimate. These algorithms know things about your spending habits that you probably don't even realize about yourself. They know that you typically buy coffee between 7 and 9 a.m. on weekdays, but never on weekends. They know you shop for groceries on Sunday afternoons, and that you always fill up your gas tank when it hits a quarter full. If you suddenly try to buy something expensive in a different state at 3 in the morning, those algorithms will flag your transaction faster than you can blink. But let's assume everything checks out and your transaction gets approved. Now the really wild part begins, because this is where the money actually moves, and it's nothing like what most people imagine. When you buy that $4 coffee, You might think the coffee shop gets $4 from your credit card company. But that's not what happens at all. The coffee shop gets approximately $3.70. The remaining 30 cents gets divided up between multiple companies you've probably never heard of, but who all played a role in processing your transaction. First, there's something called the interchange fee, which goes directly to your credit card company. This is usually between 1 and 3% of your purchase, and it's how credit card companies make most of their money. Then there's the processing fee, which goes to companies like Visa, MasterCard, or American Express for using their networks. Finally, there's the merchant processing fee, which goes to the company that provides the card reader and payment processing services to the merchant. This fee structure is why some small businesses have minimum purchase requirements for credit cards, or why gas stations often charge less for cash payments. Every time you use a credit card, the merchant pays a fee, and those fees add up quickly for businesses operating on thin profit margins. But here's the really fascinating part about how credit card companies make money, because the transaction fees are actually just the beginning. The big profits come from something much more psychological and much more profitable: human behavior patterns around debt and rewards. Credit card companies have spent decades studying exactly how people interact with credit, and they've discovered some remarkable patterns. Most people fall into one of two categories: transactors or revolvers. Transactors pay off their balance every month and never pay interest. Revolvers carry balances from month to month and pay interest charges. Here's the thing that might surprise you. Credit card companies actually lose money on transactors. If you pay off your balance every month, use rewards programs, and never pay fees, you're what the industry calls a deadbeat customer. The companies provide you with free money for 30 days, pay you rewards for spending, and make only those small transaction fees from merchants. The revolvers are where the real money comes from. The average American household carries over $6,000 in credit card debt, and they're paying interest rates that typically range from 18 to 25% annually. This is where credit card companies make their massive profits, and it's why they're constantly trying to encourage people to spend more and pay less of their balance each month. The psychological engineering behind credit cards is absolutely brilliant and slightly terrifying. Everything about the credit card experience is designed to make spending feel less painful and to encourage you to carry a balance. The plastic feels substantial and important in your hand. The rewards programs create positive associations with spending. The minimum payment options make carrying debt feel manageable and normal. Even the way credit limits work is psychologically engineered. When a credit card company gives you a $10,000 credit limit, they're not just assessing your ability to pay back $10,000. They're making a calculated bet about your behavior patterns. They know that people tend to view their credit limit as money they can afford to spend, rather than debt they need to repay. The rewards programs deserve special attention because they represent some of the most sophisticated behavioral psychology in modern business. When you earn points or cash back for spending money, your brain creates positive associations with using that credit card. The more you use it, the better you feel about using it. It's a feedback loop that encourages increased spending and deeper engagement with the credit card ecosystem. But these rewards programs also reveal something crucial about credit card economics. Companies can afford to give you 2% cash back on your purchases because they know that most people won't optimize their usage perfectly. Some people will forget to redeem rewards. Others will increase their spending to earn more rewards. And many will carry balances that generate far more interest than the rewards cost the company. The technology behind modern credit cards continues evolving at an incredible pace. Contactless payments, mobile wallet integration, and biometric authentication are just the beginning. Behind the scenes, artificial intelligence systems are getting better at detecting fraud, predicting customer behavior, and optimizing everything from credit limits to marketing offers. These AI systems can predict with remarkable accuracy which customers are likely to miss payments, which ones are at risk of defaulting, and which ones might be interested in specific financial products. They analyze not just your credit card usage, but also your social media activity, shopping patterns, location data, and hundreds of other signals to build comprehensive profiles of your financial behavior. The global scale of the credit card industry is almost impossible to comprehend. Every day, billions of transactions flow through networks that span every continent and connect virtually every business in the developed world. The infrastructure required to make this system work represents one of the most impressive technological achievements in human history. Understanding how credit cards really work gives you incredible power as a consumer. When you know that every purchase generates fees for multiple companies, you can make more informed decisions about when and how to use credit. When you understand the psychology behind rewards programs, you can optimize them for your benefit rather than falling into spending traps. The key to winning the credit card game is treating these financial tools with the respect and understanding they deserve. Credit cards aren't just convenient payment methods. They're sophisticated financial instruments that can either build wealth or destroy it, depending on how you use them. The next time you swipe your card for that morning coffee, remember that you're participating in a global financial ecosystem that touches millions of people and generates billions in profits. And in those 3 seconds between swipe and approval, you're witnessing one of the most complex and fascinating processes in modern commerce, all disguised as a simple transaction that most people take completely for granted.